An in-depth volatility analysis, Strangles versus Straddles. We're going to look at something. We started a piece yesterday on Straddles. We're going to take it to another level. We're going to take a little look at Strangles versus Straddles. So Straddles generate a higher volatility than Strangles because of a larger delta and larger gamma. That's pretty straightforward. A small movement in the underlying would cause a bigger change in P&L for a straddle. Although strategies with large deltas, such as straddles, yield a higher P&L per contract, they also have greater volatility. Take more risk, you make more money. Okay, we've been through this many times. You take a more risk, you make a more money. Lower win rate, you make more money. That's it. The median P&L you can see is about 33% higher, and the win ratio is about 30% lower. That's how all this stuff works. And the volatility of the position is about double. Now, we're not suggesting that one is better than the other. I want to be really clear about this. Nothing we do suggests that one's better than the other. Everything is theoretically accurate, and they're all going to be about the same. But there is a set of mechanics that we lay out to help you, select what kind of strategy you want to use, and knowing that you're going to have twice the P&L volatility and a lower win ratio, but you're going to make more money. Some people want to opt for making more money. Other people want the higher, they'll take lower P&L, lower volatility, and a higher win ratio. Like I said, there is not a right answer. There's lots of choices. So today we're going to look at how volatility changes over time with different strangles. So we studied SPY 45-day strangles with delta levels of 16, 30, and 50, which is a straddle. We recorded their weekly P&L changes as a percent of the underlying price. But the first thing we look at is we discovered that the P&L volatility gradually rises as we approach expiration. But this increase slows down closer to expiration. This is a 16 delta strangle. This is why we manage this when we get into week, let's call it 4.
You want a lower volatility P&L,
yeah, you want the lower volatility. That's all. You just want the lower volatility, and so that's why we manage this before volatility starts to expand. But that's a 16 delta strangle. As we move to higher delta strangles, you can see that the relationship between the first 4 weeks and the last 3 weeks actually starts to widen dramatically. And so as we move to a higher delta strangle, this is a 30 delta strangle, the volatility accelerates more quickly because you're selling bigger options. By expiration, the volatility of a 30 delta strangle is double that of a 16 delta strangle. So you're basically, by selling the bigger premium, if you manage early, you can defend the position quite easily because you're not into that danger zone. But if you wait those last 3 weeks, like mostly everybody does, except tasty traders, you got some issues. Okay, or you could have some issues.
Because of the math behind it, right?
Now you can see this is a straddle. So this is where you make the most money, but you also have the highest volatility and the lowest win percentage. And this one is where we decided, based on our research yesterday, that you should manage it 14 days. Now you can see why. Because this one, we feel like it's way better to manage after the first 2 weeks because of just the slope of the risk.
Look at how steep it is. I mean, the volatility. This has nothing to do with P&L. This is just the volatility of the overall trade, right?
Yeah. Right. This is the volatility of the trade.
This
you can see volatility spikes significantly each week, nearing 80% at expiration. A situation that traders should probably stay away from, which is really fair.
Sure.
When our research showed managing at 14 days, people wrote in and they go, that's really good because that is really helpful because that makes more sense. Because we used to say for straddles, I'd manage at 25%. But the reality is that managing at 14 days, you're at the perfect part of the curve. For the 16 delta strangle, if you want to wait 4 weeks, go ahead, wait 4 weeks. For the 30 delta strangle, if you want to wait, 3.5 weeks or whatever it is, or 3 weeks, fine. But for the 50 delta straddle, 2 weeks, perfect. And then you cut out all that crap at the back end, all that risk.
Real good. That's what you wanted.
Exiting positions at 21 DTE can significantly reduce volatility. For straddles, though, managing the position even earlier, like we said, at 14 days, can further improve the balance between profitability and volatility. So what we do at Tasty is not suggest that something is theoretically better, but it's mechanically better. In the straddle here, we're talking about a volatility reduction. Let's just talk about 21 days. It reduces the volatility dramatically, but if you want to reduce the volatility even more, move inside of that. Aggressive strategies like straddles often show higher P&L volatility and sharper increases in volatility as expiration approaches. To keep volatility within a manageable range, traders should plan to exit positions ahead of expiration. So for strategies with larger delta values, such as straddles, traders should consider exiting their positions even earlier. And like our research showed yesterday, maybe 14 days. By the way, I'm going to tell you this, my own experience.
Yes.
Holding a straddle for 14 days is pretty damn hard.
It's hard. It's almost impossible.
Yeah.
I mean, because there's so much movement just to sit with it.
Yeah, exactly. When we say it's, you don't think it's short. That's a long time.
Right.